So now it's time to try the concepts that we have learned in the last video in a particular situation. So here we have one Miss Pastry and Mr. Cake who wants to start a business in Gangtok, Sikkim, and the business is travel agency. So they are good friends and they decided to start up a business in Sikkim because Sikkim has no taxes levied on you. So income tax is exempted there. So they planned strategically and they started a business. The first transaction is started business with cash, rupees 10 lakhs. If you remember your analysis of transactions questions, in this situation you would add 10 lakhs in cash and add 10 lakhs in equity, right? So cash and capital are the two accounts involved. Cash account is an asset. I have told you that if the asset increases, we will debit it, and when capital, which is a liability, increases, it will be credited. So cash account is debited and capital account is credited. Second transaction, bought a building. Building is an asset. The building is increasing in your business, right? It is an asset and it is increasing in your business. So whenever an asset increases, we debit it. Building account debited. Whereas for buying this building, we have paid rupees 2 crores. So it has caused a deduction of rupees 2 crores in my cash balance. Cash is again an asset. So when the asset decreases, we credit it. So building account debited to cash account. Transaction 3. Bought furniture for the office rupees 1 lakh. So furniture is an asset. As the balance of asset furniture is increasing, so we debit it, and as cash is reducing by rupees 1 lakh and cash reducing, that is asset reducing, causes it to be credited. So furniture account debit to cash account. So many of the people might be having this doubt that in bank accounts, in the bank passbook, when you say something is being credited, it means we have received the amount, that is there is an inflow. But in this case, that is in accountancy, whenever your cash is credited, it means you have paid someone, you have not received from someone. So if you have received some money from someone, then cash account will be debited. Okay, so this is something that you need to remember, that bank passbook and accounts cash book are two different things. So do not amalgamate those two concepts here. Fourth transaction, bought 10 cars. As we have a business of travel agency, so we need cars, right? So Mr. Cake and Miss Pastry together bought 10 cars for rupees 10 lakh each. So the total amount would be 10 lakhs into 10 cars, which is 1 crore, which is around 1 crore. So as asset is increasing, that is vehicle account is an asset and asset is increasing, asset increase is equal to debit. Vehicle account debited rupees 1 crore. Cash account is decreasing because I am paying out 1 crore rupees. There is an outflow of cash. It is reducing my balance of cash. Cash is an asset. Reduction in asset causes credit. So vehicle account debit to cash account. Then we have fuel expenses. As I have bought the vehicles, now we need fuel to run it, right? So fuel expenses for the month were around rupees 50,000. So fuel expenses account debit to cash account. In the past video, I have shown you that if there is an increase in expenses, then we have to debit it. So as expense is increasing here, so I have debited it. Whereas cash is an asset, it is reducing. So I have credited it. Paid road taxes. Road taxes again is an expense. Expense increase means debit. Asset decrease means credit. Road tax account debit to cash account. Purchase goods worth rupees 1000 in cash. We have purchased goods in cash. So purchase account will be debited to cash. As cash is reducing, so credited, and purchase, which is a real account, so I have debited it because you have received some merchandise and it is increasing your asset, right? So it is debited. Whereas cash again is an asset which is decreasing, so it is credited. Then we have purchased goods worth rupees 1000 and credit. This time it is not on cash. This is on credit. So purchase account debit to trade payable account. Trade payable is someone to whom you will pay later on, as it is a liability, and when liability increases, we credit it. And as merchandise, that is asset, is increasing, we have debited it. Purchase goods worth rupees 1500 paid. It means you have purchased goods worth rupees of 1000 and you have paid 500 rupees cash, and still 500 rupees is yet to be paid. So what you will do? Purchase account, as merchandise is coming to my business, it is increasing my asset base, so asset increase means debit. I have debited purchase account to cash because cash is reducing, cash is going out of the business, so cash account credited because asset decrease means credit. And then we again have a trade payable. As We have not paid someone rupees 500, so it is adding up into my trade payable account. Increase in liability, so increase in liability is credit again. Then we have paid to trade payables, so this same trade payable from the previous transaction we are paying them back now. So trade payable account debit to cash account. As when I pay trade payable, so my liability will reduce, right? There is no one left in my business to whom I am supposed to pay. I am already paying them now on as on date, so it is decreasing. Liability decrease means debit, whereas I am giving them cash, so there is an outflow of cash, decrease in cash, decrease in asset, which is credited. Trade payable account debit to cash account. 11th transaction, paid only rupees 400 to the trade payable, 100 is the discount allowed by the trade payable. So in this case the trade payable is a good man and he allowed you to pay just 400 rupees and said keep the 100 rupees with you, I don't need it, I'm giving you discount. So in this case you need to pass this transaction. Trade payable account debit, as we are reducing the liability here by paying of the liability. So trade payable account debit to cash account. Cash is going out, decreasing, so credited. And then we have this new account, discount received account. Discount received account is an income account. When income increases, we have to credit it. As discount is something which is in the nature of income for you, so it is credited. Sold goods for rupees 1000 in cash. Simple entry, cash account debit to sales. Cash is an asset, increase in asset debit to sales account. Sales is income account increasing balance between credited to be credited. So 13th transaction, sold goods worth rupees 1000 on credit. So as we have not received the cash yet, we have to present that situation through some account, right? So here we will have trade receivable or debtor account, and again sales, of course. So you have made sales, income is increasing, so we credit it. Then trade receivable is an asset which is increasing, so we debited trade receivable account rupees 1000. Sold goods worth rupees 1000, 500 received in cash. It means we are yet to receive another 500 rupees from the person. So cash account debited, as cash is coming in, this cash amount is coming, so cash account debit. Trade receivable account will be created because we are supposed to get the money in the future. And then to sales, because our income is increasing by 1000.